Hey guys, and welcome to the last series of videos by Geeked on managerial accounting. Today we're going to be talking about measuring and assigning costs for income statements. So in this chapter, you're going to be introduced to two different types of income statements. One is a variable costing income statement, and the other is an absorption costing income statement. When you draw both income statements, the ending result, the operating income for both of them, is supposed to be different. And then you're expected to reconcile them to see whether both of them are correct, like all the numbers are correct. So essentially, when you're sitting in the exam, you can actually check whether you did your work right or wrong. That's the beauty of accounting. All right, guys. So let's get started with this chapter. What you really want to do in this chapter, why you draw both income statements, is because you want to compare the results and then choose the income statement that is best for your situation and your business. So we're going to get started with the question as always. So the information for a startup is given. The production costs are variable and fixed, $40 per unit and $10,000 per month. Selling and admin is variable and fixed, $9 per unit and $25,000 per month. Selling price is $89 per unit and production volume is 1,000 units, while sales volume is 850 units. Now the first part is asking us, using the variable costing method, prepare an income statement and calculate the ending inventory. So I have both the formats for both variable costing and absorption costing right here. So over here, let's have a look at the variable costing income statement first. So the biggest indicator for a variable costing income statement is when right after sales you have your variable costs. All right, guys. So I'm gonna write down my sales and then I'm gonna deduct my variable costs. Just a note for this chapter. In this chapter, you're gonna be given just 4 types of costs. So you're gonna have your variable costs, both production and selling and admin, and you're going to have your fixed costs, both production and selling and admin. You just need to know where to put them in which income statement. So when it comes to variable costing, you deduct your variable costs first, be it production or selling and admin. So you put those down and then you arrive at your contribution margin. Remember guys, that's in our first series of videos on chapter number 3, where we discuss contribution margin in detail. And then you move on to your fixed costs, you list them down, and you arrive at your operating income. Let me make a huge point here, guys. So when you're calculating your variable costs, remember this as a rule of thumb. This is what I did when I was doing this chapter. When you're doing your variable costs, remember to use the rate times the sales volume that you have. And when you're on to your fixed costs, you're going to use your production volume. When I do the question, it's going to make more sense, but just remember when you're doing the first bit, so let's think of this as the first bit of the income statement. You're going to be using the sales volume. And when you move on to the second bit of the income statement, you're going to be using the production volume. Don't get confused by what I'm saying. Let me show you how it's done. All right. So let's get started right away with this question, which says, using the variable costing method. All right, so we're going to get started with that. So as I said, for the first part, we're going to be using the sales volume, which is over here. So I'm going to multiply 850 by my selling price, which is 89, to get my sales. So equals to 850 times 89. That gives me 75,650. All right then, moving on to variable cost production. Again, I'm going to be using my sales volume. All right, so that's going to be 850 times production cost. So my variable production cost is $40 per unit. So 40 times 850. So 850 times 40. That gives me 34,000. All right then. Moving on to variable cost selling and admin. Again, same procedure. Selling and admin variable cost is $9 per unit multiplied by my sales volume, which is 850. So 850 times 9. That's it. And then my contribution margin comes out to 75,650 minus this and minus this. That comes out to 34,000 exactly. All right, we're making progress. Moving on to the fixed cost section, where we have our fixed costs given to us. So just a note right here again. So your fixed costs are given to you, like for example, 10,000 per month. This is based on your production volume, not on your sales volume. All right, your fixed costs are always based on production, because like when you're producing it, you incur fixed costs as you produce your products, right? Not as you sell them, right? So sales is not really linked to your fixed costs. So always remember that fixed costs are directly linked to production. So again, moving on back to the question. So 10,000 is my fixed production cost. So I'm going to put that down over here. and my fixed selling and admin cost is 25,000. So I'm going to put that down too. And I'm simply going to deduct these two from 34,000 to arrive at my operating income. So far, so good. That's a negative 1,000. I'm just going to highlight that. All right, now we leave this here. We'll leave our variable costing operating income alone just for now. All right, so I want to calculate my ending inventory now. Again, so always look out for the keywords, guys. So in this case, the information for a startup, right, guys? This is a startup, and as with any startup, we all know that like any startup has no opening inventory. So this company or whatever, it doesn't have any opening inventory because it started this year, right? So its opening inventory is 0. Okay, then during the year it produced 1,000 units, right? That's 8,000 units that it had in its hand. And then out of those 1,000 units, it sold 850 units. All right, that leaves us with like 150 units, right, guys? So in order for me to find my ending inventory, I'm simply going to do this. I'm going to take my 1,000 production volume units, 1,000. I'm going to deduct my 850. That leaves me with our ending inventory in units, but I want it in dollars, right? So I'm going to multiply that by my variable cost, my production variable cost per month, which is per unit, sorry, which is $40 per unit, right? So I'm going to multiply it by that. That comes out to 6,000. All right, that is my ending inventory using the variable costing method. That is it for this. We're going to leave this section and move on to absorption costing. And let me show you what's different between the two. So remember when it was variable costing, we took variable costs first and then we took our fixed costs, okay? But when we're doing absorption costing, we take our cost of goods sold. And again, this has been covered before. When we're doing cost of goods sold are basically costs directly related to production, right? So I'm going to be taking my variable cost, which is related to production, and I'm going to be taking my fixed cost, which is related to production. Then I shall arrive at my gross profit, and then I'm going to move on to the selling and admin, both variable cost and fixed cost. And finally, I'm going to arrive at my operating income. There is going to be a difference, but I'm going to show you how to reconcile that. Okay, so in order, again, remember when I mentioned the first part uses the sales volume and the second part uses the production volume. Always remember that, guys. That is the key concept in this chapter, and that can really throw some students off, like including myself. I was really confused about that, but then I made it a rule of thumb. I just remembered it for the exam. All right, guys, so sales I'm not going to recalculate because sales is going to be the same, right? It's going to be $89 per unit times 850, right? That stays the same. Sales doesn't change between the two methods, so I'm just going to copy that here. Cost of goods sold, so variable cost of production. So let's take our variable cost over here. That's production, $40 per unit, again, multiplied by 850. So $40 per unit multiplied by 850, that gives me 34,000, just as it did over here. Okay, then moving on to fixed cost production. That is where people get confused a lot. Okay, so remember when I said that you use sales volume over here, right? But your fixed cost is 10,000 per month. However, this 10,000 is based on 1,000 units. Like that's your production, right? So that is what your fixed costs are based on. So this is sort of like flexible budgeting. You're gonna find the rate that you found at the start of the year or whatever, and then you're gonna multiply it to the actual number of units that you sold, which is 850. So if I divide 10,000 by 1,000 units, that comes out to 10 per month, right? That's my rate. So that comes out to $10 per month multiplied by 850, which is my sales volume. In the first part, I'm going to be using sales volume. So that multiplied by 850, that comes out to 8,500. So that is the only difference. Notice here that my fixed cost for production is 8,500 over here, whereas over here it was 10,000. So that is a big difference between the two methods, right? So you might want to keep an eye out for that. Otherwise, the rest of the figures should be the same. Let's see if they are. So that my gross profit is much different from my contribution margin, as you can see. Okay, then moving on to other expenses, variable cost, selling and admin. This is going to be based on my actuals, right, guys? Remember, this is going to be based on my actuals. So variable cost, selling and admin. Remember, selling and admin is based on sales, right? It's logical. Selling and admin, it's based on sales volume, right, guys? So your variable cost for selling and admin is going to be based on your sales units. So it's going to be equal to $9 per unit multiplied by 850. So 9 times 850, that comes out to 7650, the same figure that we have over here. And then fixed cost, selling and admin should come out to the same amount, because again, this 25,000 per month, it's fixed and it's selling an admin, so we don't touch that because this is the second part of the income statement. Remember that, guys. The second part of the income statement we do not really change to suit the current sales volume or whatever. We don't really touch this part. We assume that it's going to stay the same, so we're going to just copy this 25,000 onto the income statement. So that's going to be like 25,000, and then that comes out to like 33,150 minus these two. That comes out to 500. All right, so we have our operating incomes for both methods. Now moving on to absorption costing, ending inventory. There's going to be a significant difference between the two because we use a different method here, right? So this is how we find our ending inventory. So we already know that we have 150 units from here. We already know that we have 150 units left over, right? That multiplied by my variable cost, which is 40 per unit. Okay, that's the same procedure that we did here. Plus, we're gonna have to incorporate this 8,500. Remember, guys, that this 8,500 is less than the 10,000 over here because we use a different method, right? So we have to include that 1,500 into our calculations. So we're simply gonna take the 10,000, the $10 per like the $10 of fixed cost that we took, the rate that we found here, and then we're gonna multiply it by our ending inventory. So 150 times 10. And that comes out to 7,500. So that's a difference of 1,500 between the two ending inventories, right? So on to the third part. I forgot to mention that we were doing the second part, but now we're finally on the third part, which is reconcile the difference in incomes. And that is the easiest part. So we're simply going to take the variable costing operating income first, and then we simply get copy it here, which is a minus 1,000. And then we take any changes, any fixed costs in opening inventory. So what that means, let me just tell you. So over here, we don't have any fixed costs in opening inventory. Remember, we took the 10 bucks from here and we added it to absorption costing because that's how absorption costing works. But over here, we don't have any fixed costs. So the fixed costs anyway in opening inventory, you don't have any opening inventory, right? So that's simply going to be 0 because you simply don't have any opening inventory. If you did, then you would compare the fixed costs between the two income statements, and then you would put that difference in there. Moving on to fixed costs in ending inventory. Ending inventory. And the difference between the two, look here, like ending inventory here is 6,000, whereas over here it's 7,500, right, guys? So there's a difference of 1,500, right? So I'm just going to put that down, and then this the two income statements are going to reconcile now. So whatever answer I get, it should be the absorption costing operating income that I got. So essentially, you can check your answer in the exam. So 1,000 minus 1,000 plus 0 plus 1,500, that comes out to 500, and that's my final answer that I found here. So notice that I started with this negative 1,000 and I arrived at 500 just by comparing the two and reconciling the two figures. Alright, so guys, so that is it for chapter 15 and for managerial accounting as well. That's a wrap. Now I'm going to be moving on to my financial management videos. So stay tuned, and just if you have any questions, again, if you have any questions, you want me to solve any questions for you, you have any comments, feedback, you can always email us at inquiries2geeked@gmail.com. I hope that this channel is productive and it helps you understand the concepts, and I really look forward to hearing back from you guys. Stay tuned for more great videos.